Now we're just going to pivot over into the refined products world, specifically in the US. And here you can see that when we look at all of the activity, we had a nice increase from 13.86 million barrels a day of demand all the way back to 14.263 million barrels a day. But that's very much in line with what we've been expecting. And that's where we've been seeing some of that trend up. And you can see it's still falling below what is normal. And a lot of the increase this past week was on residual fuel, which can be a bit back and forth in terms of some of the spikes up and down. So typically you get a spike up, then you get a spike down. But we should be holding at about that 14 million barrel a day average. And then when you look at that February period, you can see that there's a steady pivot up that starts at the middle of Feb. That's February break. Typically, that kind of has a soft kickoff to what is normally to come because you have Ash Wednesday that usually falls around that time. You have a decent amount of travel. Things start to get a bit warmer, and you start to get that steady move up, and then you kind of flatline through spring to then get that shift up that happens at the end of May. And then obviously you have the summer driving season. So we normally get this pivot. It's just, as we've been saying from the beginning, the pivot's going to underwhelm versus historics. A lot of that is driven based on just changing driving patterns, change in the way that distillate is being consumed with a fall in underlying diesel flows. Warm weather, so if you think about the warmer weather that is happening is great for driving, not great for heating oil. There's a good chance it gets colder in the north again coming into the end of Feb, but that's again going to be a big piece that we want to look at. But on the other side, we're going to have that shortfall driven by the lack of trucking. Distillate stocks had a small drop of 1.29 million. You can see that there was a nice build in pad 1, a nice draw in pad 3, and a lot of that draw in pad 3 was driven by the a lot of exports continuing to flow and some of those different movements. But we also have that reduction in refining capacity. So as refiners come down for planned maintenance, run cuts in some shape, way, or form, that's going to indicate some of these different shifts. And it's going to keep things a bit lower. So remember, we had a nice spike in imports into pad 1. Now we have a drop of 470,000 barrels a day, and a lot of that is driven by pad 1 with a drop of 468,000 into pad 1. But even with that drop, there was actually a build, and the reason why is because of weather and the lack of demand from the shipping side. So you're getting it from both sides, which is putting us a little bit closer back to normal. So now when we look at the diesel crack spread, you can see that things are kind of holding in a bit. They've come down a touch, but again, they're still holding at a higher side of it, going back to 2018, 2017, but it's just at the lower end of the scale, and that's why we continue to see some of those overhangs in terms of just runs, because gasoline isn't great, and now diesel continues to soften. Now, when you look at pad 1, again, counter-seasonal builds moving back up into a little bit more of a comfortable spot, but still at the low end of a 29-year average, on the lower end. So if we don't get much if we don't get cooler weather from now until March, you'll continue to see this ratchet up and get closer to that average, because remember, the comps get easier. We're normally drawing at this point in time. Instead, we're getting some nice counter-seasonal builds, which is helping to alleviate some of that pressure. Pad 3 coming down again, as we've been saying, trying to manage some of these flows, and they're doing it through some refinery utilization rates. They're doing it based on exports, and that's going to continue to be the case. So when you look at demand in the U.S., again, as we've been saying, it's going to stay at the lower end of the cloud just because trucking continues to disappoint. We don't see that changing based on what is coming down the pike from shipping all the way out. And we continue to see some of these pricing in general remain soft. Here's where you look at the trucking market, again, just fairly flat, and that's where we think we're going to live. And it's still at the higher end when you look at 2014 to 2019, but when you look at what was the driver of 21 and 22, this massive surge, and then you got that big drop in 22, that's where we think we're going to live at this point and just have tougher comps in general. But then when you start looking at FreightWave's National Truckload Index, it's moving down. And this is indicative of more pressure, just not a whole lot of people moving stuff. On the Econ show, we've talked about how inventories are building. As inventories build, they're going to companies are going to try to work through that inventory. Nobody's going to be in any hurry to push through additional. We did get a nice retail number, retail spending number. It's one where we thought we were going to come down again. Instead, we had a nice January. We're going to talk more about that in the Econ show in terms of, is that a one-off? Do we get some continuation into February? And that could help alleviate some of that inventory and see some of those bumps in general. But then when you marry that with shifts in the way people are doing business, the nationwide office index monthly visits, in January, we were 40.2% below pre-COVID. And that's, if you look going back through August, 37.7 below, 41.2, 42.4. We've been saying that we're going to stay about 40% below normal, and that there's nothing out there to show that's changing, because businesses are looking now at, and people want flexible schedule. That's going to change the way people do lunch and purchase, and that's again going to shift some of those shipments. It's also going to shift a lot of that driving data and some of the gasoline consumption. So then when you look at the U.S. rail traffic, you can see total carloads came down, chemicals came down. Obviously, we're going to talk more about tomorrow, the issues with NSC. NSC is the train company that was managing the rail and the train that derailed in East Palestine, which they had when you have the product that they were carrying, vinyl chloride, there was pressure being built up, and instead of allowing for an uncontrolled explosion, which would send shrapnel everywhere, there's typically a controlled burn that takes place. The problem is there was a lot of product that they're currently burning, and there's a lot of this movement of product into other areas that is creating just this broad sweep of a cloud. And it looks like some of this product got into the Ohio River. Right now, there's data back and forth in terms of how much damage is there to wildlife, to all these different people. There's a lot of these different components that have to be looked at, and those different pieces are: what is the payment? How much are people going to get compensated? NSC sent out a small check. Now, anybody who's into legal knows that you don't send a check because that's an admission that you owe them something. And not to say that they don't, but you go through the process of what is the right number. And so again, that's a long way of saying that fees are going to go up, carloads might come down. And it's going to be more costly for different individuals just to move hazmat material, because regulation usually follows some of these disasters. Then there was another in Texas. There was another in South Carolina. And you might be thinking, well, there's espionage. There's something happening here. There's some sort of nefarious activity, or they were under maintained rail lines that then resulted in a bigger problem. Because we've overused the rail, they didn't do a lot of maintenance, and things are breaking at a greater clip, which is also a possibility. Grain and farm products are going to stay elevated. Petroleum products are going to stay strong, but as we've been saying, intermodal is going to continue to weaken, and here we have another big drop in intermodal. And there's going to be, again, some fallout. A lot of things are going to happen, so it's going to be something to watch. Now, when we go backwards and look at just stuff coming into the U.S., here you can see that their shipments continue to fall well below last year, well below previous week. And again, things are just moving in the wrong direction when you look at shipments, which is pointing to slower global growth, slower global trade, because the U.S. is the largest buyer. And it just also points to just less demand for truck and rail coming forward. When you look at the temperature, you can see that there's a lot of warmth that still remains on the East Coast all the way into parts of the Midwest, with some below average temperatures coming down from the south. And a lot of that is that La Nina shift. So you have some of that Arctic air coming down. You have that La Nina shift, which is pushing some of that warm air up. And the question is going to be, how strong does that stay? If La Nina weakens, that could the cooler air could come down. And it's going to look to what does the end of February look like and what does the beginning of March look like. Because if you remember, March has been colder than previously, but we've had some warmth. But this is not a good situation for both natural gas as well as heating oil. Now pivoting to gasoline, we had a build of 2.32 million. That brings us just below 12.5 million barrels, below the 5-year average. And a lot of that, again, is being driven by Pad 2 and Pad 1 as Pad 3 kind of normalizes. Pad 1 had a big build even as imports came down. Imports came down into Pad 1, 398,000 barrels a day. But that's still above the 5-year average. And some of these shifts here in terms of storage and price. Remember, last week we talked about how there are 2 additional boats that were going to discharge into the New York Harbor, Pad 1. Instead, they got redirected out because there just wasn't enough demand. And now the arb is closed again a bit, coming from Europe into the U.S. But remember, there's a lot of gasoline sitting in Europe. So we do expect that to open up again just to see some of that maintenance. But one of the key things that we've been saying is we're not going to get to these highs that we saw the last couple of years. Instead, we're gonna start to flatline a bit because remember, February break, going to pull down some of that storage, and instead the comps just get a bit easier. And where we think we converge is more in mid-March, where we're not going to get the draws that we normally get, and instead we're going to see some of that closing the gap. Blending components came in at only 1.08. And that just means that some of the builds, because remember the blending components, the builds were higher than the gasoline stock, which is a bit of a prerequisite for what's coming. And instead, now the build wasn't as much, which indicates that the builds next week won't be as much. If anything, we might actually get a draw again back to the February break pull. Here you can see blending components, again, kind of leveling out. And that's what we've been saying as well. You know, we're not going to get to those highs, but we're going to merge much sooner because we don't have that petchem demand. So the options for a lot of blending components are, do you go into petrochemicals? Do you go into the gasoline pool? And we continue to see things coming to the gasoline pool. Here you can see that Gas Buddy modeled a slightly better number. But when we look at where things are, again, not too much has changed in general. You know, we expect to stay between that 8.2, 8.4 up to this point. And now we should get a nice bump to about 8.5 into 8.6 as we go into February break. You know, people are going to travel. President's weekend into Feb break. That's going to put more cars on the road, more miles on cars. And then the question is going to be, are we going to stay up there or come down a bit? And the way that things are shaping up, we expect to see a nice pop and then a fade, well below what is normal. When you look at Asia Pacific ex-China, we're going to talk China in segment 3. You can see things have remained below that 2019 average. Europe, some headwinds into Europe. A lot of that is driven based on cost, more pressure on the consumer, less economic growth. So again, Europe rolling over, and then North America sitting at that pretty stable number, which we think is closer to the new normal. A lot of that being driven based on a lack of movements back to the office. But we will get a bump because of February break, which could take us back above the 2019 average. Again, a lot of that is just going to be just based on timing. So when we look at price, when you're just looking at gasoline prices have started to come down a bit, still at the higher end with diesel, still wafting around, but making some new lows. Given where heating oil demand is, or really lack thereof, we could actually see some additional pressure to the downside on diesel pricing, which will be a positive for the supply chain in general. But again, you can see that things still remain elevated going back through the last few years. Now, when we look at gasoline demand in general, here you can see that there is that gasoline demand staying at the low end. it's tracking at but when you, as we said in segment one, this is where we normally get that pivot. We normally get a nice little bounce to the upside. And it starts either last week, this week, or next week, depending on kind of where that February break falls. It falls a bit later. It actually falls during Ash Wednesday. Typically, Ash Wednesday is right after February break. Again, it's all about timing. So here we continue to see some of these movements higher, and it's still going to be at the low end. And that's the concern that we continue to have, is gasoline demand is not going to be the driver that it was in the previous years. We're getting that change in just status, and just the people are not going to the office as much. People aren't doing as much. And as those economic headwinds continue to mount, people are just going to do less, and again, stay to the low end of that. Propane/propylene had a draw of 2.58 million. It's still 14.3 above the 5-year average, and you can see that the rate of change, we should be getting draws. It's just we're staying at the very high end of the demand cycle. Very high end of the storage cycle, and a lot of that is because of the slowdown in petrochemical demand, as well as the slowdown in heating demand. So again, that's just, and then we've actually had a decent increase in supply, which is putting more product in storage. So now when we look at jet had an increase of 710,000 barrels. Demand came down, but remember, we've been saying 14.45, 15.55. We're 1.45, 1.55. We're right in that realm. We will get a nice spike next week, just because, again, we're going to have travel. We're going to have February break, and that's going to put more people in the sky. TSA checkpoint getting a bit better, staying above the 2019 year average. Euro remains weak, and we actually don't see too much of that change in the near term, just given some of those headwinds. And this is, again, just looking at that TSA number. And you can see that there's usually that shift up, and that shift up that is coming, that's February break. And so, again, it's just we will get that pivot back up that we've been talking about. Now, when you look at open table, things slowed down. It should be of no surprise that yesterday being Valentine's Day, we had a nice spike. So not surprising, but when you take that out, you can see that things remain below normal in the U.S. and on a global basis, and that's pressure that we think is going to continue to mount as pricing for food continues to ratchet up abroad. Eating out. So that's what we have for you on the U.S. front. In the next segment, we're going to go deeper into the global markets and some of the shifts that we're seeing in general on that front.